I do think markets are getting a little desensitized.
That's what I mean, yeah.
Yeah, and I think part of it is if someone had an investor hat on, not tactical hat, you know, really good opportunities are emerging because the number of stocks below the 200-day moving average was like 15%. Historically, that's a strong buy signal. I mean, you're going to find a lot of bargains there, and the VIX got above 50, and it almost always pays you to buy the stocks when VIX is above 50. But in the near term, it's a roller coaster. I mean, it does feel like we're having a lot of zigs and zags, and even over the weekend. But to me, I think everything that happened over the weekend, including the Sunday further explanations, all of this is still unequivocally positive for stocks. Well, our year end originally was 6,600, but we thought we could touch 7,000 mid-year. I think the 6,600 is still possible, but I do think the 7,100 mid-year is obviously it'd be very difficult to reach.
Tom Lee opens the conversation by addressing the volatility that's been plaguing markets. He describes the current environment as a roller coaster, marked by zags and zigs, yet believes that this turbulence is creating generational opportunities for investors. Only about 15% of stocks are currently above their 200-day moving average, historically a strong buy signal. When combined with the VIX spiking above 50, this suggests the kind of panic-driven environment where long-term investors can find serious bargains.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I do think markets are getting a little desensitized.
That's what I mean, yeah.
Yeah, and I think part of it is if someone had an investor hat on, not tactical hat, you know, really good opportunities are emerging because the number of stocks below the 200-day moving average was like 15%. Historically, that's a strong buy signal. I mean, you're going to find a lot of bargains there, and the VIX got above 50, and it almost always pays you to buy the stocks when VIX is above 50. But in the near term, it's a roller coaster. I mean, it does feel like we're having a lot of zigs and zags, and even over the weekend. But to me, I think everything that happened over the weekend, including the Sunday further explanations, all of this is still unequivocally positive for stocks. Well, our year end originally was 6,600, but we thought we could touch 7,000 mid-year. I think the 6,600 is still possible, but I do think the 7,100 mid-year is obviously it'd be very difficult to reach.
So
but it's possible.
6,600 by year end. What about you've made a lot of good calls based on moderating inflation. What did you make those numbers at the end of the week?
Well, I think that if we didn't have to consider tariffs, inflation is definitely tracking below expectations.
I mean, where the Fed wants it, almost.
Yeah. I mean, core inflation month over month at 0.00056. I mean, that's like literally hitting a wall.
Now, is that for good reasons or for bad reasons?
I think it's for the right reasons because...
Oil?
Yeah, well, there's oil and foods off the boil, but it really is shelter is actually cooling to a 2% rate, and that is what you need to get inflation back down to 2. I think that is the narrative at the moment, that, you know, U.S. exceptionalism's over and people are selling treasuries and dollars to buy other assets. But I'm not in that camp that it's sustainable, because unless weaker dollar and higher yields suddenly makes the best companies in the world outside the U.S., you know, the best and the most important companies in the world are American companies. They've produced the best shareholder returns. And, you know, if you look at the S&P, 40% of the returns of the S&P come from new companies every 10 years. Is there going to be suddenly the best new company coming out of Europe instead of the U.S. because of the dollar? And I doubt it. And I think U.S. companies are going to adapt.
The advantage that they both share, is that they're global assets. So if you do get, you know, capital repatriation, so capital coming out of the U.S., that can hurt U.S. stocks, but doesn't necessarily hurt gold or Bitcoin to the same degree. And the correlation with the NASDAQ, I've done a lot of research on this, and I think the shared correlation that they had is that they were both heavily correlated with liquidity for a number of years, especially in kind of the 2020 afterward environment. So prior to then, Bitcoin had less correlation with the NASDAQ or the S&P. And starting in 2020, that correlation went up because these big macro forces were just much larger pieces of many asset price swings. And a scenario where Bitcoin can decouple from the NASDAQ is one where you have like tariff-driven stagflation. If the margins of those NASDAQ companies themselves are what's challenged, and yet if liquidity is not heavily impaired, if the Fed goes back to, gradually not doing QT anymore and doing some QE, and the deficits remain very large, you can get an environment where liquidity is not that bad, but margins are impacted, earnings aren't going up or aren't going up to the same degree. They're starting from a pretty expensive valuation level. And so you can have a couple years of poor stock price performance while more liquidity driven assets like gold or Bitcoin that don't have margins to worry about can still do okay. And so, I gold's had a really strong period. So the value investor in me is always a little bit wary when something goes up that much, but I continue to hold as a slice of my portfolio instead of bonds. That's one of the things I try to focus on, is that I use cash equivalents or gold as some of the more defensive sides of my portfolio rather than traditionally using long duration bonds as many would. And then I treat Bitcoin as a similar exposure that I would in an equity. So whatever percentage of equity I take out and put in Bitcoin instead, but I've been very satisfied with that approach. I think the way I would describe it is I'm not necessarily would have the view that bond yields would keep going up, but rather that probably at minimum they wouldn't go down as much as people think in an otherwise recession or economic problem scenario. So they don't necessarily provide the ballast that investors would want. And then that view can be exacerbated by hard to predict things like China purposely selling treasuries as one of the tools in their arsenal. So there's Boolean outcomes there for whether certain events happen that could make yields go up a lot more than we think. But the base case would just be that yields are not giving the offset. So they're not making, things more affordable for people. They're not lowering government interest expense. They're not helping with discounted cash flow calculations. So they don't, if bond yields go down, at least you can say, well, maybe equity valuations are allowed to be a little bit higher now. But if bond yields aren't going down, you don't have that offset. They impact mortgage rates indirectly. So you get less refinancing potential, which has an impact on the economy. And so I think that's kind of the base scenario is choppy range bound in yields with potential for disruption should certain events occur, certain kind of intentional events, and depending on how the Fed responds to those attempts, if they happen.
A potential stagflation scenario looms large in both experts' minds. This would involve persistent tariffs, disrupted supply chains, and large fiscal deficits monetized through central bank action. It's not today's base case, but it's a possibility. Stagflation would hit profit margins and hinder equities, while assets like gold and Bitcoin, which don't rely on earnings, could shine. Lyn highlights that any policy mix that involves tariffs and money printing is likely to lead to this kind of outcome.
If you do tax it somewhere else, if you raise tariffs and keep them up and they're transparent enough so companies know how to actually build and invest to take them into account, then over time they can impact the trade deficit. I think the main issue is going after kind of the dollar as the global reserve currency. I think one of the most effective strategies for trying to reduce the trade deficit would be, if anything, to encourage a multipolar currency world, which is to say, maybe not all these global financing contracts have to be in dollars. Maybe if China's making them, they should be making them in Chinese currency. And that could be part of an accord, for example. And so basically you can have the Chinese currency be more used in the eastern part of the world. You can have the dollar obviously be used in our part of the world and the euro in their part of the world. And you can have a somewhat more multipolar world that puts less of the imbalances on just one country. But the issue is that, generally speaking, if the goal is to have everything all at once, like you don't want to give up anything about the dollar, but you also want to fix the trade deficits, then you risk losing both or not really gaining ground on either of them. So I think that there's going to be tough decisions ahead on trade-offs. This imbalance has benefited some and harmed others. And so the short version is that if you were to swing the pendulum back the other way, there are people benefiting from that, but then there are people who are hurt from it, and many of them will fight back. They'll call their politicians and say, this is hurting me. I'm going to change, who I lobby, for example. Those changes tend to take time. So longer term, I think that the U.S. can work on its trade deficit, but it's inherently a very multi-year thing. Yeah, I do it in an unlevered way, and I do it kind of in the framework of a long-term investor, which is that I sell cash secured puts, or in some cases covered calls, but in this market it's a lot of cash secured puts, which is to say there are certain stocks I'd be happy to own, maybe not at these current price levels, and so I'm willing to sell a cash secured put at a price that might be 10-20% lower, collect what is a pretty big premium in a volatile market, and then not really care about the outcome. If the stock goes down and gets put to me, I view it as kind of buying the dip in a stock that I like and that I've done analysis on, and I'm happy with those valuations and the risk with it. Or the market stays up or rips and I still collect the premium. And I'm like, well, so I didn't buy the dip on that company, but I got paid to take on the potential obligation to buy that. So yeah, when I do selling volatility, it's not those big like levered speculative types of selling vol where you're fine every day and then it's like the turkey at Thanksgiving where you just get wrecked all at once. I do it in an unlevered way for the purpose of reducing risk rather than maximizing profit. So even this de-escalation is still a multi-$100 billion annual tax increase that hits right away and can cause distress in pockets of the market. So I think we're seeing some price action today that is indicative that maybe we're not out of the woods financially or economically just because there's been some degree of de-escalation. I think the prior uncertainty and the prior levels would have, of course, been even more impactful. As for whether they're inflationary or disinflationary, I would start with the kind of the premise that sustained higher inflation pretty much requires money supply growth in order to get that. So money supply growth doesn't necessarily lead to price increases because it could all be offset by productivity gains. So if you double the money supply, but you get way more efficient at making everything, you could have many things not go up in price. But in general, one of the necessary inputs for structural price increases is money supply growth, because otherwise it's got to come from somewhere else. And so I think that the opening volley here is some prices, especially ones that are now associated with China, are likely inflationary. Other products could be disinflationary because you can slow down the economy. And so the things that people need and they can't get elsewhere can go up in price. Other things they don't need or can get elsewhere can go down in price because demand is weaker. And then you can also get disinflation in asset prices, basically weaker asset price returns to fuel some of those consumptive patterns. And so I think it's the type of recession that if you get it, whether it's inflationary would partially depend on what's happening on the fiscal side, partially what's happening on the Fed side. So if they go back to QE, increasing their balance sheet to support some of those fiscal deficits in the bond market in particular, if that were to happen, then that's how you get a stagflationary scenario in my view, that you basically have higher tariffs on goods, less supply chains in disarray, combined with large monetized fiscal deficits. We're not there yet, but that's a scenario that's certainly on my radar.
Both Tom and Lyn agree, markets are in a highly sensitive, narrative-driven state. The U.S. economy is resilient, but global dynamics, from China's treasury selling to shifting currency usage, create real headwinds. Investors need to be selective, nimble, and most importantly, long-term oriented. Whether it's through cash-secured puts, diversified allocations to gold or Bitcoin, or simply understanding when volatility presents opportunity, there's no room for complacency. Please like and subscribe.